Thank you, Yo. Good morning, everyone, and thank you for IQPC for having us here today. And I'm very honored to be seated here together with a distinguished panel of speakers. We have about 30 minutes or so for the panel discussion. I must start with saying I'm a mezzanine funder, so I'm kind of like a thorn among the bushes here, roses, you may say, that we actually work together with buyout funds, and to date, actually, we haven't. So I'm really looking forward to this to really learn about how they see the market going forward and what has been the challenges in the past. Maybe if I can start from left to right, just a very quick introduction on the panel of speakers today, and then I'll jump into the questions.
Hi, morning. I'm Chiman from 57 Stars. We are previously known by the name of PCGI, so some of you may find 57 Stars to be like an unfamiliar name. So a bit on the company background, we are headquarters in Washington, D.C. We are a private equity funds of funds, investing globally outside of the U.S. and Western Europe, so primarily in emerging markets like Asia, Latin America, Central Eastern Europe, Africa. And of course, we do have small exposure to the developed economies like Japan, Korea, Australia, and all that. So.
Hi, I'm Dennis Barsky. I'm a partner at Jones Day, which is an international law firm based here in Singapore. I run the Asia Private Equity Group at the firm. We focus on two main areas, the formation of private equity and other funds, including hedge funds, and we also work on buyouts and growth capital transactions for funds and others. So I've been in Asia since 2001 with a brief stint back in New York. My background in the U.S. was primarily on buyouts, and I've done some of that work here. Although I think, as we'll discuss, the level of buyout activity in Southeast Asia is maybe not what it's billed to be, given the panel. Although hopefully that'll change, and there's certainly some opportunities.
Alistair Morrison. I run the Standard Chartered private equity platform globally. We started that business in Singapore 9 years ago and have cumulatively invested about $2.2 billion in Asian private equity, and that's a mixture of development capital and buyouts. We've been successful in Southeast Asia in particular in terms of keeping the run rate up against our competitors in Asia. The China and India story always attracts attention, but we're delighted that we continue to see a stream of opportunities in Southeast Asia, and we can talk some more about that in a moment.
Thank you. David?
Thanks, Alistair. Hi, I'm David Osborne. I'm one of the managing partners at Cap Asia. My colleague Johan told you a bit about us earlier, so I won't repeat that. But for those of you who perhaps came in a little bit later, we're very briefly a mid-market private equity firm that focuses on the infrastructure space across non-BRIC emerging Asia, but Southeast Asia is our specific sort of home territory, put it that way. As for me, I've been in Asia for 3 years, but a long background in private equity and buyout investing in Europe. 25 years, in fact, and I'll remind Alistair that my first job in private equity shows you how small a world it really was sitting a couple of desks away from Alistair in London when his hair wasn't quite as white as it is now, and I actually had some hair to speak of at all, so that's my background. And Sandy, you may want to reintroduce yourself.
Well, I hope in 25 years my hair stays like this. Thank you, David. Sandy Uno. I was a moderator of the last session, and this won't be my last appearance in the stage, so you got to bear with me. I founded Saratoga Capital 13 years ago. It's a private equity fund based in Jakarta, Indonesia. We're a Southeast Asia, Indonesia-focused fund, and we're focusing on investments in natural resources, domestic consumptions, as well as infrastructure. Thank you, Chris.
Thank you, Sandy. I think I will tell you that you should be very honored in seeing Sandy in a suit. Typically he's running around in Indonesia in very expensive batik. Yes. And there is no set way as to how we're sitting with the primary buyout practitioners this side and us as fund of funds, legal, and the mezzanine guy on the left. But let's start with Sandy going down left on my side. Clearly, most buyout funds have gone through the last 3 years with a real relook in their business. I think it's safe to say that no buyout fund, is coming out of the recession in the same way they went into it. Can you tell us a little bit about your strategy before the crisis, and then post the crisis? How has that changed for you with regard to your ability to do the deals and the types of financing that you will seek to support your strategy?
I guess in 2007 and early part of 2008, we were so flush with liquidities, and not only the mezzanine money or mezzanine capital that would be able to do to be shoehorned for a buyout, but also banks behaving like mezzanine guys, providing liquidity that really increase competitions as well as valuations of the companies that we're looking. Then 2008 hit, the global financial crisis. Whilst Indonesia, our primary market, was not that hit that badly, it still grew 4% in 2008. Basically, liquidity went from abundant to zero in less than 2 weeks. And it just changed the entire landscape and perspective on doing deals. So the large buyouts that are available to be basically structured with a lot of financing is now have to be primarily financed by equity. But what happened in Indonesia and I think a large part of the other areas in Southeast Asia that we're looking, valuations did not come down too much, and maybe it's because of lack of supply, but the valuation stays there now. And in the case of Indonesia, it's even higher now. So I guess that's what's happening from right after the global financial crisis. And Chris, I have to admit, more competitions. There are more people with bigger checkbook coming to this region, especially to Indonesia, and looking for deal in a bigger size.
David? Yeah, I think, well, look, this is more of a personal journey than a corporate one, but I think in a region like Southeast Asia, given its diversity and relative shallowness of market, I think I personally have chosen to move from a very global and generalist investor to one that is much more regionally focused and also sectorally focused. And I think if you look at the challenges facing the industry going forward, and it was touched on earlier in many of the discussions, to really justify our role in the value chain and to help to create and add value to the businesses we invest in, sector focus is going to be an increasingly important element to that. To add value, you need that operational expertise within the business. You need the network of contacts to bring into businesses to really help them transform, make the most, optimize themselves operationally from a marketing perspective, from a capital structure perspective as well, of course. So I think there are a number of strategies that I think the industry will evolve to take account of this new paradigm. But in a personal sense, it's around sector focus, I think, for the next few years.
Alistair?
Yeah, thanks. I guess my observations are that what we saw coming out of the crisis was a huge amount of trauma in the private equity markets in the West because they'd been dependent on debt to get their returns, whereas I saw very few instances of crazy lending practices in capital structures in Asia. One or two have got into trouble, probably where the leverage was too aggressive relative to the operational gearing of the business. But it wasn't a pandemic like the industry suffered in the West. My worry at the moment is that although we hadn't got crazy before, there is now so much money chasing deals and a great appetite for competitive situations. And I'm talking really Asia-wide more so than Southeast Asia, that we might have not learnt the lessons that our brothers in the West have learnt very painfully. And in chasing deals down, the levels of leverage start to creep into the danger zone. So I think that the disciplines that were exhibited sort of pre and post the crisis in Asia were probably rather stronger. My worry is whether we're going to keep our disciplines in the next couple of years with the weight of money chasing transactions.
Yeah, I think that's a pretty good point about coming through the crisis. Everyone says, well, things have changed, but things have actually changed to be more competitive, and sometimes sanity, kind of goes out its door, and money has a very short-term memory. Dennis, I'd like to hear about, as you have advised on transactions, as you've seen deals being executed, we've had some pretty crazy situations that were leading up to the crisis whereby people just pretty much threw a lot of the covenants out the door, or they relinquish a lot of the things in the legal docs as they negotiate transactions. Are you seeing that behavior in the deals that you're seeing now vis-a-vis the ones that you were advising pre-crisis?
Thanks. I think that's a great question. I guess maybe the fundamental tenet of the sort of the question that's gone around the panel so far is, was the global financial crisis a transformative event such that funds are now conducting business differently coming out of it, or was it simply a blip? We've gone beyond it, and now we're back to the same general practices that we were seeing pre-crisis. So I think where we are right now is we're seeing a very busy and active deal market. I'm not personally in the things that I'm working on and that I see my clients dealing with. We're not dealing with crazy amounts of leverage. I mean, I'm not seeing any covenant light transactions, certainly, and I don't know that they're back anywhere at the moment. So I guess that's one. Once we start seeing covenant light again, maybe we know we've really gone full circle. But I am still seeing quite low leverage for transactions out here. So even buyout deals, keeping it at like 2.5 times EBITDA just because of the target company, the management that's rolling over, they're just nervous about high leverage, even if the PE fund would be more than willing, and they can find banks more than willing to sort of layer on the additional debt. In terms of overall deal terms, I do think that because the deal activity has picked up and because the landscape is increasingly competitive, that we're moving into an area now where buyers are basically willing to throw out some of the key asks that they might have really cared about maybe 12 or 18 months ago, give up some points in the indemnities and escrows and other things in order to get the deal done, because they feel like they're chasing deals. There's too many guys out there, and if they can get something at the right valuation, they better lock it in now.
Chiman, to shift gears to the fundraising side, I think many of us in the room know that fundraising is not the same as it was 5 years ago, or even 3-4 years ago. And we've seen all asset classes pretty much recover to pre-crisis levels, but the level of interest in, call it, illiquid fund investing is not the same as it was 3 to 4 years ago. What are you thinking about when you look at funds across the region, particularly buyouts in Southeast Asia? Are you seeing that this is a key area for you to focus on? If there are key concerns, what might that be?
I think in terms of the fundraising environment, because Southeast Asia presents a very different risk-return profile as compared to, let's say, the China and India. I mean, to go back to the financial crisis point, whereby one thing I see from the financial crisis of how it helps the Southeast Asia buyout opportunities is, before the crisis, you could see a lot of the Southeast Asia deals whereby the GP did a lot of work, and in the end, let's say, return 2x, whereby in China, whereby you could feel that the fund managers didn't do much, and then they return 5x. And as a fund of funds manager, there's always a struggle between this guy did a lot of work, 2x. That guy, sort of did nothing, 5x. Which one do you invest? And one thing that come out from the crisis was that the when you have buyout opportunities, when you have control of the companies, that gives the private equity fund managers, I mean, for lack of a better word, more control over the companies, and they're able to execute more, be it from cost cutting, be it from financing, be it on corporate governance. And I think that is a lesson that some investors learn through the crisis. And as such, I think going forward, there will be, I think, a slightly heavier look into the buyout opportunities in Asia, whereby previously people kept always saying that, oh, there's not much buyout in Asia and it's primarily Singapore and all that. But I think going forward, there will be some interest, although it will still be overshadowed by China and India. It's more of, I would say for investors, it's more of after you do your China, your India, then you would consider Southeast Asia.
I see. Okay, well, it sounds like we're kind of struggling against different geographies, but tell us a little bit about fundraising, Sandy, as you in your daily conversations or regular conversations with potential funders. What have been their key kind of skeptical kind of questions, and what are the key things? I mean, clearly there's capital coming from somewhere. Clearly there's competition coming from somewhere, but you stand front and center some of these guys and they say, wow, you know, buyout, you know, China, India, why would I want to spend my time in Southeast Asia? Walk us through some of the key questions that you get asked, and how do you address them?
In our case, is actually just transform to a completely different story only like 6-9 months ago, whereby previously it was just getting the attention for Indonesia and Southeast Asia would be very difficult, and then the type of questions that we got in terms of politics, macroeconomics, stability, and then the type of issues like corporate governance, alignment of interests, how do you basically deal with the the ethical situations, especially when you're focusing your investments in Indonesia. 6 to 9 months ago, it's completely changed. Now everybody wants to have an exposure on Indonesia. I used to have to make like 3 months booking to get their time to see them in Hong Kong or other parts of the world. Now they come to Jakarta to my office. So it's quite a change, and there are not that many products, private equity alternatives in Indonesia, so only a handful of options for them. So it's changing from, in the whole year, maybe 3 years ago, I would see would-be investors 3 or 4 in the entire year, to right now maybe 3 a week coming to Indonesia and looking at this. So I agree with Alistair. There's a sense of sort of like a herd mentality rush in looking at this, but we have not seen, or we're seeing now some of this potential turn into real commitment. Some people trying to get exposures in Indonesia and turn that attentions to commitment. So we have to see what's going to happen in the next year or 2 from now. But in terms of fundraising, it was really, really difficult and really tough 3-4 years ago. And it's relatively, we can get their attention much better now.
David, tell us a bit about fundraising.
Yes, I'd agree, and I think the challenges are sort of moved on from the geographic ones from an LP's perspective. Yeah, look, I think there is clearly a move towards allocating funds towards Southeast Asia. They see the wider Asian opportunity, and no doubt India and China are clearly the biggest markets, but they typically now have got the exposures they want there. They're seeing, if anything, those markets becoming overly competitive, and see Southeast Asia as a natural place to expand into. So I think those are not the sorts of challenges we face from LPs. I think it's more about clarity